On October 10, 2025, Bitcoin fell from $121,000 to $106,000 in minutes. In 1 hour, $7 billion in leverage positions evaporated. By the end of the day, $19 billion was gone. 1.6 million trading accounts were liquidated, wiped out. Some people lost everything they owned. Others lost money they didn't have and ended up in debt. One Ukrainian crypto trader named Konstantin Galik was found dead in his Lamborghini 3 days later with a gunshot wound to the head. He had sent farewell messages to loved ones saying he was depressed about the crash. He allegedly lost between $7 and $60 million. This is what happens when leverage meets volatility. When seconds become the difference between wealth and ruin. This is the story of crypto flash crash survivors. The ones who lived to tell the tale, and the ones who didn't. Let's start with what a flash crash actually is. In traditional markets, a flash crash is a sudden, dramatic price drop followed by a quick recovery. The most famous example is May 6, 2010, when the Dow Jones dropped nearly 1,000 points in minutes before bouncing back. It was caused by algorithmic trading and a lack of liquidity. But crypto flash crashes are different. They're faster, more brutal, and they happen because of leverage. In crypto, traders can borrow 10, 50, even 100 times their account balance to make bigger bets. If you have $1,000 and use 100 times leverage, you're controlling $100,000 worth of crypto. If the price moves 1% against you, you lose everything. If it moves 10%, you don't just lose your $1,000. You owe the exchange money. And when thousands of over-leveraged traders get liquidated at the same time, it creates a cascade. Prices fall. Liquidations trigger. Prices fall more. More liquidations. It's a death spiral. May 19, 2021 was the first mega crash. Bitcoin had been surging all year. It hit an all-time high of $64,000 in April. Then China announced a crackdown on Bitcoin mining. On May 19th, the bottom fell out. Bitcoin dropped from 42,000 to 30,000 in hours. Ethereum crashed from 3,500 to 1,900. In 24 hours, over $8 billion in leverage positions were liquidated. On the exchange Deribit alone, there were 296 bankruptcies in Ethereum and 609 in Bitcoin. These weren't people who made bad trades. These were people whose margin got called so fast they couldn't react. The exchanges tried to implement circuit breakers, pausing trading when prices moved more than 2.5% per second. But even circuit breakers couldn't stop the bleeding. Traders watched helplessly as their accounts went negative. They owed money to exchanges that they would never be able to pay back. One trader later described the experience. He had been conservatively leveraged at 3 times. He thought he was safe. But when Bitcoin dropped 30% in a day, his 3 times leverage meant he lost 90% of his account. He tried to add more collateral to prevent liquidation. But the network was so congested it took hours for his deposit to clear. By the time it arrived, his position was already liquidated. He lost $47,000, his life savings. Another trader had used 10 times leverage betting Bitcoin would go up. When the crash happened, he was asleep. He woke up to an email saying his account balance was negative $12,000. He didn't have $12,000. He worked at a grocery store. The exchange threatened legal action if he didn't pay. He eventually negotiated it down to $4,000 paid over 18 months. But the psychological damage was permanent. He had nightmares about leverage for years. The survivors of May 2021 learned hard lessons. Many quit crypto entirely. Others swore off leverage forever. But as memory faded and prices recovered, a new generation of traders entered the market, and they made the same mistakes. By 2025, perpetual futures contracts, the main instrument for leverage, made up nearly 70% of all crypto trading volume. 70%. The market had become a casino where most bets were made with borrowed money. Exchanges loved it because they collected fees on every trade. Market makers loved it because over-leveraged retail traders are predictable and easy to profit from. The only people who didn't love it were the traders themselves. But they kept doing it anyway, because when leverage works, it feels like magic. Turn $1,000 into $10,000 overnight. Why wouldn't you? Then came October 10th, 2025. Bitcoin had been rallying. It hit $125,000, a new all-time high. Traders were euphoric. Then at 5 p.m. Eastern Time, Donald Trump announced 100% tariffs on all Chinese imports. Markets panicked, but traditional stock markets were closed. It was Friday evening, so all the fear, all the selling pressure, went into the one market that never sleeps: cryptocurrency. Bitcoin dropped from 125,000 to 102,000 in less than an hour. Ethereum fell from 4,800 to 4,100. Altcoins collapsed 30 to 70%. And the liquidations started. In the first hour alone, $7 billion in long positions were liquidated. By the end of 24 hours, $19 billion was gone. Some estimates put it as high as $30 billion if you include underreported liquidations from smaller exchanges. 1.6 million trading accounts were wiped out. To put that in perspective, the FTX collapse in 2022 only caused about $10 billion in losses. This was twice as bad in one day. A trader who goes by the username I am Jackie's posted on social media, "I gotta say, I've never seen anything like this in my entire, longer than a decade investing career." Another prominent crypto investor, Lark Davis, tweeted, "Worst liquidation event ever in the history of crypto today. Worse than FTX, worse than COVID, worse than 2018. The human toll was immediate." Traders flooded social media with stories of ruin. One person had invested his wedding fund. Gone. Another had used a home equity line of credit to trade crypto with 50 times leverage. He now owed $200,000 on a house worth $300,000. A college student had turned $5,000 into $80,000 over 6 months using leverage. He got greedy and went all in with 100 times leverage right before the crash. He lost everything and ended up owing the exchange $3,000 he didn't have. And then there was Konstantin Galik, known online as Kostya Kudo. Galik was a 32-year-old Ukrainian crypto fund manager and influencer. He drove a Lamborghini. He posted videos about his trading success. He claimed his crypto holdings were insured for losses up to 15%. He paid investors a fixed monthly return of 7% regardless of market conditions. Classic signs of a Ponzi scheme. When the October crash happened, Galik allegedly lost between $7 and $60 million, depending on which Ukrainian news source you believe. On October 10th, he sent farewell messages to family saying he was depressed about financial difficulties. The next day, October 11th, police found him dead in his Lamborghini Urus in Kyiv with a gunshot wound to the head. A firearm registered to him was at the scene. Police initially called it suicide, but later reports suggested he may have been under pressure from corrupt officials demanding a share of his income. Whether it was suicide or murder, the trigger was the crash. And Galik wasn't the only casualty. Several other crypto traders reportedly took their own lives in the weeks following October 10th. Their names weren't as famous. Their deaths didn't make international news, but they were just as dead. So who survived? And how? The survivors shared common traits. First, they used little to no leverage. Traders who owned crypto outright could ride out the crash. Yes, their portfolios dropped 15 to 30%, but they didn't get liquidated. They still had their coins. Within 2 weeks, Bitcoin recovered to 115,000. The unleveraged traders recovered most of their losses. Second, survivors had stop losses that actually worked. Many traders set stop losses, but discovered during the crash that exchanges had disabled them or they didn't execute due to lack of liquidity. The survivors either had better exchanges or got lucky with timing. Third, survivors didn't panic sell. When prices crashed, the instinct is to sell everything and preserve whatever's left. But that locks in losses. The survivors who held through the volatility recovered. But here's the uncomfortable truth. The real survivors weren't retail traders. They were institutions. At least one whale on the exchange, Hyperliquid, shorted Bitcoin and Ethereum right before the crash and made $190 million when prices tanked. Did they have inside information about Trump's tariff announcement? Maybe. Maybe not. But they timed it perfectly. Market makers also profited. During high volatility, bid-ask spreads widened dramatically. Market makers captured those spreads on every transaction. They made fortunes while retail traders burned. And the exchanges themselves made money on fees. Every liquidation is a forced trade. And every trade generates fees. Binance alone probably made tens of millions in fees during the October crash. The house always wins. Even during a crash. Especially during a crash. What can we learn from crypto flash crash survivors? First, leverage is not your friend. It will destroy you eventually. The math is unforgiving. You have to be right every single time. The market only has to be wrong once. Second, if something seems too good to be true, it is. Konstantin Gallic promising 7% monthly returns was a scam. People knew it was a scam, but they invested anyway because greed is powerful. Third, when markets are highly leveraged, crashes are inevitable. It's not a question of if, it's when. And finally, the survivors are the ones who plan for disaster, who use less leverage, who have cash reserves, who don't bet everything on one trade. They're boring. They don't get rich overnight, but they also don't lose everything in a flash crash. And when the dust settles and everyone else is liquidated, they're still standing, ready to buy the dip with actual money, not borrowed, not leveraged, just theirs. The crypto flash crashes of 2021 and 2025 are not the last. They will happen again, because the incentive structure encourages it. Exchanges profit from leverage. Traders believe they can time the market, and crashes create opportunities for those with capital. The cycle repeats. The only question is who will be the next Konstantin Gallic, and who will survive to trade another day.